Hey everybody. Hopefully everything's going all right with you guys. It is 3:25, getting close to the end of the March here, and apologize for not posting a video in the last couple of weeks here. I've been on vacation. Things have been a little bit nuts, but I finally think we're getting to a point where we can start to talk about next steps here over what we can expect here out of markets. So what you're seeing here is really like a just a microcosm of the entire market. It's been nothing but just straight parabolic up. We had maybe like 1-2% down day, back when we were at around the 4,800 level, but ultimately it never stuck. So, I guess the big question everybody else has on their mind is what comes next? How high are we going to go? Could we go to the moon? Nobody knows. So, what I'm going to try to do here is give you guys a little bit of context. So, for those of you who are new to Elliott wave, or really just like regular wave analysis, there are certain structures that are pretty easily identified. And the one I'm looking at here, I'm thinking is it's an irregular. So it's also called an expanding flat or whatever. Doesn't really matter. It's the general concept that we make a new high and we continue on that high until we reach a point of resistance. And you would have thought we would have hit that point of resistance already many times, but we have not. So you start to go back and start to do some measurements and start to do some do your homework really and start to look at the charts, look at the patterns, kind of see where we're at. And I think we could probably all agree here that the latest rally has been really just ridiculous. I mean, it's made a lot of people a lot of money, but when you look at it like this and you kind of zoom in at the daily level, it really is. It's it's not exactly parabolic, but it's pretty damn close. And when we look at it like this, we can see a pretty clear ABC pattern here. And when you draw these measurements here, typically what you'll see is A equals C, or the A leg here, which is what we're measuring here. This A, and then this flag that we saw way back in October, really is when it wrapped up, and then the C leg up. Now, typically, these C legs don't really stop at A equals C at 100% here, but that's kind of what we're seeing today. Um, I don't know if it's going to have enough gas in the tank here to reach all the way up here to this extension level. I kind of think that we're going to see some declining volume, which is something we can see right around here. Um, this orange line here is a 20-day moving average. So it peaks up a little bit here. We've got some contract changes. We've got some rebalancing, all sorts of fun stuff here. So that kind of throws off and skews it a bit. We could look at ES, which is really just a futures ticker, and that gives you a little bit more context here. So we can see that with futures that it's just gone straight up crazy bananas. Um, there really is a case here to make it up to the 5,500 mark. I certainly hope that's not the case. However, um, I think most people are short now, or they've at least been distributing where we should see some sort of pullback. I kind of think that we might see, because this is technically an overthrow, and this is a long-term pattern with this. I guess you can call it a microphone or you know no, there's lots of different names for these patterns. But what I'm thinking here is we might see an extension up here to this 1.236 level. Um, but I don't think that's going to happen just straight up. I think what we might see is some sort of pullback corrective wave, um, and how you might characterize this is like it's just a smaller ABC on a larger scale. But even a pullback like this, all the way back to 5,000, I'd say would be a welcomed correction, so people can buy the dip, and people who are selling. I mean, I don't even know who has shares left over because they've had 4 months to distribute everything here up at these levels. So those who haven't sold their shares, um, I don't know what you're doing, but this market has been absolutely bananas. So this is a perfect selling opportunity for institutional sellers. But for retail buyers and retail sellers, you probably went short right around here. right around the 5100 mark or 5000, something like that. Um, or slightly higher because we're getting close to this trend line. I'm sure there's lots of rationale for why why retail, what short, or this, that, and the other thing. So to get more focused on the point here, we are seeing a very, very pronounced just total run here on what the expectations were. We did see a couple days of selling. Now, if we zoom in to SPX, as soon as we jumped over this, and this is by design, by the way, this ascending, really, really tight channel here, I guess you could say. Um, as soon as we jumped above this, they closed the gap right away. I mean, it took them 2 days, but why sell it down fast when you can sell at higher levels? So the bulls are really just driving this home higher, and the bears are just getting wrecked again, again and again and again. The bears are really a glutton for punishment. But when it comes to these sorts of chart patterns, the risk reward of shorting versus going long is starting to look very, very attractive. From the point where you see a lot of these structures when you do charting, and this 100% extension level here, this 5220 level, this was a pretty significant level because in my opinion it's really 5220 or it's 5482. There's really no in between. And even though we are seeing some in between right here, either we're going to see a rejection pretty quickly, maybe beginning of next week, uh, or the beginning of April, something like that. But I really just wanted to spend some time here and talk through why some of this is coming to fruition, or why I think that some of this might actually happen. So if we layer in the 10-year yield and we try to we try to kind of analyze what's going on here. Typically, the yield's negatively correlated to equities, but we saw a bit of a flag here, and we still see that flag. And again, if we zoom to the 10-year chart, and we go in real close, we will see that it's forming this some sort of ascending channel here, and typically once we get to the top here, it's going to be bearish. I think what we're forming here is a longer term B wave. But those who've the students of the market have typically so here, let's just draw something real quick. Typically, students of the market will know that when bond rates start falling, then also equities typically fall. Now that's not exactly like set in stone, right? So we have, if we go back to SPX, we have this, super high channel. If we measure this out, we have, let's see here, we have 28%. That's ridiculous. So markets just don't go up in a straight line, but apparently it has. So you are taking part in a historic rally. Um, and again, if you're short. I'm sorry. It will get better, and hopefully it'll get better soon. But long story short, here is 28% run is nothing that's actually going to be sustainable long term. So I would highly recommend that if you're looking at this and you're thinking about going long, or I mean, well, you might have to head shorts, of course, but if you're going long, you really might need to take a look at this and ask yourself, like, what's the next step, right? Like, where do we go from here? And sure, yeah, we could go a little bit higher. Why not? But at some point, we got to blow off some steam. And at some point, you can't just go up and up and up. So we priced in, not we, but the big players here priced in, um, with 6 rate cuts for this year. The Fed dot plot that they showed back in November that set the market off on a tear. Really was in danger of heading way lower. But this, and actually, I was going to say this structure here is very conducive, and this fooled me too. The structure is very conducive to a 5 wave down sort of move. And why we didn't see that is I just think that the bulls just kept buying and buying and buying. And again, why crash the market or why sell down the market if you've already had what is this 2 months of distribution here, or reaccumulation, whatever you want to say. I mean, it's a 10% correction. Those don't typically happen more than, let's say, once or twice a year. You don't typically see more than a 10% correction, um, let's say every 2 years, maybe three. Um, but what we saw here, I do believe is like a B wave, and a B wave again typically it can fool a lot of people because it can be, let's say, just to draw this again, it could be a 1-2 setup, which is like the golden setup that everybody likes to see, um, where if you short right around here, right around this, 4,500 level, 4,530, that's where, you would have made a lot of money if the market did actually turn there. But as we all know, it did not. And I feel like that trapped a lot of people. They had to flip long. So if you zoom in here, you can kind of see here that we had a pretty big gap right around, um, I'm thinking that's kind of the, yeah, here we go. So this 0.618 retrace level. This would have been a very logical point for equities to reverse, or at least like the S&P. But we gapped way above it on, I can't even remember what the catalyst was, but it doesn't matter. Okay, this is all where the fun and games come in. So having this gap up here at this 0.618 level is an engineered sort of thing by people that have a vested interest in really just cranking the market up. So not seeing a reversal right around here was a telltale sign that we probably should have had shorts, or taken a small loss, something like that, and set some stops, etc. But the next level that people looked for was this 4,500 level. Now we didn't pivot here, but what we could see, or sorry, not could see, we did see it, but this 0.786 level, that's another typical reversal point for a wave two. And again, this will be the third time I've drawn this, but um, we would like to see something like this, where if you're looking for an actual like zigzag sort of correction, this would be the next sort of step. Um, but since we did not see that, then we need to start considering other possibilities or other scenarios. And in this case, we saw it just totally blow past the 0.786 retracement, from that, from the selling that we had all the way from July down to the bottom here at, close to the end of October. So with the Fed now saying that they're not, going to reduce rates yet in March, I bet you they won't even do it in June. But still, markets were just waiting, grinding up, etc. And when we look at, we'll pull up ES here for futures. We see some higher volume here, with the latest ascent. So you see a lot of people buying the dip. You see, at least just reading the volume here, you see a lot of people buying the dip. You see them selling the rip, and ultimately just driving higher and higher with consistent buying. And why I think we've continued our buying spree is, again, on the backs of the news of the Fed. But you can still see that we got a little bit of weakness here with this, the ascent in price and the decline in volume. Now, typically, when you see a decline in volume and a divergence in price, whether it be up or down, typically that means that we're going to have some sort of reversal, or there's buying fatigue or selling fatigue, you know, things like that. So how do we make sense of this all? So we showed the 10-year yield, which really is helpful, but we also do have problems where at tops and things it does flip and it's not as reliable, with normal market trading. But since we're starting to see, actually it's probably more helpful to pull up the 10-year. Since we're starting to see this sort of dip here, I do think we'll probably see something like this, like a very small, um, we might see some sort of small, pop and a drop, which might be that last little squeeze here that we have with equities. Now, if that's the case, this would be a really good buying opportunity right around like the 4.2% level. You can already see the purple is the 50-day exponential moving average, and the 200 is a turquoise line here. So you'll see, sorry, I also have the 20 on here as well, but it's starting to converge. And it's definitely in an upward trend, but typically with these ascending sort of patterns, um, you see something like, let's say it taps and then it drops and then spikes, or you see just a constant grind here while it's testing these trend lines, and then it heads up to a major fib level, and then it pivots. Now we do have some time here. I mean, we got pretty much all through April, likely May here to just grind up a little bit with the rates, and that's going to put some pressure on consumers. It's going to put some pressure on real estate, autos, anything really that requires debt financing because it's just going to get more and more expensive. We're already we're already starting to see some reports of luxury goods falling with sales. People sounding the alarm like Macy's, like, oh man, no people are buying our stuff. Well, okay. Um, in my opinion, that's a warning sign. So again, if you are long and strong and you think that the market isn't coming down ever, it's going to go straight to the moon. Well, in my opinion, I believe that that's false. And if we don't see some sort of reversal soon, then the bulls may be correct again, and we may head higher. But again, I hope not, because if you have this constant run, like you have this constant, upward channel with almost no viable dips, then people get anxious or people get, scared of buying. So I think about it like if you're an institution, what do? You have all these shares you're distributing. Okay, well, you still need people to buy your expensive shares. So maybe you take your foot off the selling gas and you let them just, keep pushing it higher, which is what they've done. And I think they've done a really good job of faking us all out by, having a couple of strong sell days where you fake people into shorting and then you rip it up the next day, and that traps a lot of shorts and fuels the rise higher. But um, I do feel like if we don't make a new high, like at this 52.60 level. If we don't make a new high and we don't keep going up here, I think that we've probably seen the top. Um, it might be famous last words, of course, because I've probably said that a couple times already. But I do think that now that we've reached this 100% level, this A equals C, I think that it's either now or it's going to be way later. And I think that also too with the macroeconomic conditions, we're like there's good stories, there's things that are coming to fruition. We have good numbers, but it's still running a little hot for the Fed. So the Fed's not going to reduce rates, and the Fed is talking about, let's say, June. But I guarantee you, if inflation or CPI or PCI, things like that keep coming in hot, they're not going to reduce rates. I think what they're doing is they're trying to thread the needle here, and likely it's going to be unsuccessful in a macro level. But I think they're trying to give the Treasury a break, where they're not increasing rates where they should. Another 0.25 basis points isn't going to kill anybody, but they don't want to raise the rates because the Treasury can't afford to service the debt and the new bonds and things that have been issued with all the new spending, all the new debt. And I also think too that what you'll see is the Fed needs to unload its balance sheet and prepare itself because it's if we do have a recession, let's say 2025 or late 2024, we also have an election where you might see some padding in the markets, but we also still have a lot of time yet before the election. So you could see some sort of correction, or let's say even 10% again. Um, let's say it happens tomorrow, which would be interesting, but you might see something maybe a little bit more like this, maybe 11, 12%, where that would still give you pretty close to the highs that we had a couple years ago now at, in 2021, or at the end of 2021. So we're getting to the point here where we have, total excess of markets again, and it's really unsustainable, but just like any other bubble or any other, thing. And yes, it is a bubble, by the way. Yes, just accept it, move on. It's a bubble. You're buying expensive shares. Um, it can continue, and like all the other bubbles, there can just be mania. But we have seen the mania, and I don't want to say it's wrapped up, but we have gotten to a point where we've really seen crazy buying, uh, lots of volume and just buying crap shares. Like for example, if you look at Nvidia, look at this. It's parabolic, guys. Come on, use your brains. This is not sustainable. Okay, so can Nvidia get to 1,000? Yeah, it probably will, and it's a main driver of the market. So you see, lots of volume, lots of things pushing this up. This is typical bubble behavior. So don't be fooled. Don't think that the market's going to infinity, because at some point it will correct and you will be stuck holding in a very expensive bag of shitty shares. But the reality is that you need to be prepared and understand like what drives some of these things. So to wrap up the whole diatribe here on SPX, or S&P 500, it really does look like a corrective sort of structure. And yes, we could extend higher. Absolutely, there's always that possibility. But in my opinion, the risk reward of buying right here, right at this 5220 level, the risk of buying right here is much more scary than I would say taking a short, for example. Sure, if it creeps up higher, might go fast, but I think that there's buying fatigue. I think that there's been a lot of institutions that have distributed enough shares where they're happy, they're fat with profits. We got to take it down a little bit so we can accumulate more. And I think that that time is coming soon. So to wrap this up, I would say maybe take your profits. You can leave some runners, sure, absolutely. And again, it's not really advice. It's just I'm looking at this from an angle of I've seen this. I've been trapped short. I've been different situations. Um, where market just keeps going up and up and up. But I do think we're at the point right now where people are holding off on buying more, and I do feel like we're starting to see that with some of the volume where over the last couple days here, I drew this before, where it's declining, but prices are still going up. So in that case, also too, if you look at the Nasdaq, you might see something similar, where we're seeing this pretty clear ending pattern. Again, it's probably a little easier to see if you do it on the 2 hour, but we've seen a pretty clear ending pattern here. But it's starting to get a little bit messy towards the end here, but you can also see a pretty clear, 5 wave up pattern, and we may hit this May. Okay, so yeah, likely we're going to hit this 18,800 level probably this week. We had a little bit of selling. We'll probably sell down here and tap a level, and then we'll shoot up. It's just it's sort of par for the course now. Um, but this has also been a very long and extended sort of ending pattern. So again, long story short, I do think that, again, moving back to SPX here, we'll probably see some sort of another attempt at the high or to make a new high, and we'll just keep grinding. But if we don't make a new high, that's going to be an issue for the bulls, especially if there's some high volume. Um, and again, looking at Nasdaq, you might see this push higher, and sure, we might hit this 18,800 level, but uh, kind of thinking that we might see a pretty swift reversal, and you can also see it too here with the volume. The volume is declining. We're seeing spikes up, and this is also where you're starting to get that bear capitulation. The people that went short around here, or the people that went short over here, that was yeah, that was a month and a half ago. Like if you're holding on to shorts for that long, I mean, it gets pretty depressing. And you need to have a little bit of perspective, where if you take a step back and realize that markets do actually move pretty slow, intraday movements are fast, but if you're looking at this from a high level, like a daily level, you can really start to see some of these major developments here. So again, we did have some selling. We had some people buying the dip, but I do think that we'll probably see one more pop here. And again, this is probably correlated here to the yield, because we're already starting to see flag here, which would be really good if you had some TMV, if you're playing ETFs. But this looks like a pretty clear flag to me, a bull flag. So we may have one more test of this, of these moving averages, but I do think that we're going to scream higher here with rates, and I think equities are going to be on the bad side of the trade. So, with that all being said, just wanted to say that that's the overall analysis really for equities. Um, just giving a quick shout out here to let's say YM or the Dow. So the Dow is again, it's another pretty clear wave pattern. Again, we might extend a little bit higher here, but this 40,000 levels, I think, pretty reliable. Sure, we may have some like a B wave here and a pretty small thing, but I do expect this range to break pretty soon. If we look at Russell 2000, again, this is another example of this regular flat I was talking about. Um, we didn't see a new high here back last Friday when we had that big rally, and this might be your 1-2 setup. We did see a pretty big sell candle here on Friday late in the day, but I do expect it to maybe rise just a little bit more. But I think that the turkey is cooked here with the Russell 2000 if we can continue to see the 10-year yield make higher highs and continue. All right, so that's about it here. But the high level view is essentially, I think we're going to go up a little bit more, but then we're testing the top. If you look at something like Nasdaq or the SPX here, I think we'll test the top, and then I think we'll reject pretty quickly. So that's it. I think that it's going to take a little bit of luck for short, but also it's going to take a little bit of motivated sellers to take this market down. But if it gives you any hope, if you're already short, I do see declining volume. I see the wrapping up of a pretty long ending pattern. And again, you know, institutions only have so many shares to sell. They gotta have portfolios. They gotta do all sorts of stuff. They have rules that you and I don't have. But once they're out of shares, they move the market. Either it's up or down. So declining volume typically means there's less buy interest or less sell interest, and that's a good catalyst for a pivot. So whether that happens tomorrow, nobody knows. But I think realistically, you'll see another attempt at a high this week, and then next week, I think we'll probably see a rip down. All right, good luck, everybody. See ya.